Where does CQS think we are in the credit cycle?
That's a very good question. We do think, of course, and the reality is this cycle has been running for a long time, but we still see some potential for this credit cycle to continue. We think the growth environment in the world is improving. Some of the geopolitical deals that are being worked out, sometimes with some temporary difficulties, will add to that upside in the growth environment. So we do think the credit cycle still has a few more years to run.
Just in the last couple of days, though, we've got so many growth downgrades. The ECB, the OECD,
yes.
China. And I know China is, for you, a bellwether for the credit cycle.
Yes.
So tell us more about why you think there's still a good picture for growth out there.
And it's a very good question, because the growth, whilst we believe the credit cycle and the growth cycle will continue, the picture is mixed. If you look at Europe, for example, in some sectors, distressed will be a big opportunity. The economic recovery that we saw, the fairly tepid economic recovery we saw in the Eurozone 2 years ago, has now essentially flattened out, and monetary policies are likely to be more supportive going forward in a monetary sense. So the EU, in terms of liquidity, I think will see a renewal of central bank action. China is really quite a different situation, and I spend myself a lot of time there. I think what we heard earlier with your colleague talking about the CSI 300 and the Shanghai Exchange picking up, something really important is happening in China. Of course, you don't expect an economy of that size to grow at 7% forever. But China is looking today at ways in which it could recalibrate its economy towards consumption, towards innovation, and for this, it needs vibrant equity and capital markets. We think the economy, the opportunity in China is very, very substantial. 50% of total assets under management growth last year was in China. So whilst the US remains, by and large, the largest market in the world with over 55% of all financial assets owned here, growth opportunities, particularly focusing on technology, green debt, there's $1 trillion ESG market in China, means that these opportunities in capital markets and investment are there. The economy is obviously forged ahead, but we're at the stage where capital markets are catching up. And the opportunities, we believe, over the next few years, particularly in mainland China, will be very substantial.
Mr. Rolet, the volatility in China, though, has been extreme. You look
Correct.
at what happened towards the back end of last year. How much sort of volatility will global investors tolerate, given what we've seen in China thus far?
That's a very good question. Last year, the A50 and the Chinese market really were under very severe pressure. And I think those investors that were fully invested in China and have endured the pain will be rewarded this year in China. Something very important is happening. You'll recall that the Chinese government, President Xi, did crack down on what is described as shadow banking and capital market. Those policies are evolving today, and there's definitely a renewed focus on funding innovation, the real economy, small and mid-sized enterprises, scaling up that technology with the help of capital markets. So I think China is making an important decision, is to open up its capital markets to fund growth, which is unfortunately not the decision that historically has been made in Europe, where the economy remains essentially dependent on bank funding and bank debt and has undersized capital markets. So I think this year will be a transformational year potentially in China, and one certainly to look at with a great deal of care for investment opportunities in domestic industries, technology-led industries.
I'm just going to ask you a slightly sort of related question to what you just said about Europe and the Capital Markets Union. The Capital Markets Union is going nowhere in a hurry at the moment. As you say, Mr. Rolet, Europe relies on the bank channel, particularly SME businesses rely on the bank channel to provide funding. The ECB is expected to deliver another TLTRO tomorrow. Given the kind of capital markets history that you have, would that be a mistake in terms of generating further forward momentum in the capital markets process?
It's a good question. It's a personal view. It seems that the ECB has become not just the first, but the last line of defense in terms of propping up economic growth. There's a structural job deficit of about 20 million in the EU, and there are 23 million small and mid-sized enterprises that could create these jobs. Unfortunately, the fiscal and regulatory framework in Europe is deeply disadvantageous to long-term patient capital, particularly equities. Equity markets represent $40 billion a day in terms of daily turnover throughout the EU. In the US, it's 5 times that, and China has $500 billion days. So in my view, Europe needs to urgently recalibrate its fiscal and regulatory regime to give equity a better chance in order to help scale up these technology-based businesses that could create the jobs of tomorrow. And relying almost exclusively on monetary policy, I think, whilst it can protect the economic situation in the short term, will not create the growth of tomorrow that is needed to achieve political stability in the EU.